Welcome, ladies and gentlemen, to another edition of Accounting 101 Made Simple by J. Ham. Today's topics discuss lesson number 4. We will cover the current liabilities on the balance sheet, part 1, accounts payable and accrued expenses. Current liabilities. As we discussed in lesson video number 1, a liability is something that a person or company owns to someone else or another company, usually a sum of money. It is a sacrifice of your assets or future economic benefits, as we previously mentioned. It is the money that a company owes to someone else. Liabilities take money out of the company's pocket, and like assets, liabilities can be classified as either current or non-current on a company's balance sheet, depending on whether the company intends on paying off the liability within 12 months, which would be considered current, or more than 12 months, which would be considered non-current. Some examples of current liabilities are as follows: accounts payable, accrued expenses, short-term loans or debt, notes payable, mortgage payable, interest payable, salaries payable, overdrafts payable, and unearned revenue or sales. In this video lesson, we will cover accounts payable and accrued expense accounts. So current liabilities, accounts payable. Accounts payable is a current liability account of a company in which the company has both incurred the liability and knows the exact amount of the liability to the penny. And the reason why I put quotation marks around the phrase exact amount is because I want you to associate that phrase with accounts payable. For an example, if a company receives a $300 bill from Verizon for telephone services for its office for the month just passed, the company would record $300 in its accounts payable account. Because the liability of the telephone services were incurred or received the benefit of the actual telephone service, the company knows the exact amount of the telephone service of the bill or vendor's invoice from Verizon. They can record that amount in accounts payable. A keynote to take away from accounts payable is that accounts payable represents known or exact liabilities, not merely estimations of liabilities. Another type of current liability is called an accrued expense account. So accrued expenses is a current liability account of a company in which the company has incurred the liability, but contrary to accounts payable, does not know the exact amount to the penny of the liability. So sticking with our Verizon example, say if a company received telephone services for the past month for Verizon, but has not yet received the bill or vendor's invoice from Verizon, the company would then have to estimate what the bill would be when they actually receive it in the mail. So say if the company estimates that the bill would be $250 for the month, the company would simply record the $250 in the accrued expenses account. Because the liability of the telephone services were incurred, which is received the benefit of the actual service, in this case, telephone services, but the company does not know the exact amount of the telephone service because they haven't received the bill or invoice yet, they should record that amount in its accrued expense account. When the actual bill from Verizon is received subsequently, the company would then reclass the liability from the accrued expense account to the accounts payable account. A keynote to take away from accrued expenses is that accrued expenses represents unknown or an estimation of liabilities, whereas accounts payable represents known or exact liabilities. So sticking with our Verizon example, say if a company records the $250 estimation of what the Verizon bill would be in its accrued expense account, and a week later they receive the actual bill from Verizon, and the company notices that the bill is for actually $300 instead of $250 that they recorded. The company would then reclass or take out the $250 from the accrued expenses account and put it into the accounts payable account, and add an additional $50 to the accounts payable account as well. At this point, the company will have a total of $300 in its accounts payable account, which reflects the exact liability of the telephone services. In the accounting profession, this process is known as the true-up of accrued expenses. And true-up simply means that the company is either increasing or decreasing its estimated liability to reflect the amount stated on the vendor's invoice, which represents the exact liability. So a key note repeated here is, again, accrued expenses represents unknown or an estimation of liabilities, whereas accounts payable represents known or exact liabilities. It's very important to understand the difference between the two, because a lot of these questions will pop up on your accounting examinations, either in grad school and in undergrad as well. Problem time. Question 1. The Coca-Cola Company received utility services for the month of August, but has not yet received a bill or invoice from Con Edison. The company's accountant estimates that the actual amount of the bill would be $3,000 for the month of August. Which of the following accounts would the company record the liability? A. Accounts payable. B. Current liability. C. Accounts receivable. Or D. Accrued expenses. Now, I put a permanent side note here. As always, when solving multiple choice questions, always eliminate the obvious wrong answers to increase your odds of answering the question correctly. So we know that we receive utility services, but we have not yet received the bill. So we know that this is not going to be an exact liability, it's going to be an estimation of liability. So we'll look at accounts payable first, and we can rule that out as a possible correct answer, because in accounts payable, we would have to know what the exact liability is to the penny. Current asset is very ambiguous. It's not specific in terms of what is the current liability. So is it accounts payable current liability? Is it accrued expense liability? Because of its ambiguity, we have to eliminate that as a possible answer. So let's move on to C, accounts receivable. We know from lesson number 1, when we covered current assets, that accounts receivable is a current asset, and the reason why is it's because it's money that our customers owe us for services that we either render to the customer or products that we either ship to the customer and they have not paid the bill yet. But because we anticipate receiving that money from the customer within the 12-month period, that would be classified as a current asset. So we can rule that as a possible answer to the question. We're left with accrued expenses. And what are accrued expenses? As we previously discussed, an estimation of a liability. So if we look into our question, we know that the Coca-Cola Company, while they receive utility services from Con Ed, they have not received a bill yet from Con Ed. So they would have to make an estimation of what that liability is going to be for the month of August. Therefore, they would have to put that $3,000 into the accrued expense account. Therefore, the answer to question 1 is D, accrued expenses. Question number 2. IBM receives a $1,000 bill from Xerox for copying services rendered stemming from the use of its copier at its Armonk, New York headquarters. How would IBM record this liability? A, $1,000 in accrued expenses. B, $1,000 in current assets. C, $1,000 in accounts payable. Or D, $1,000 in accounts receivable. Remember, when solving these multiple choice questions, always eliminate the obvious wrong answers to increase your odds of answering the question correctly. We know that IBM received a bill from Verizon for $1,000. We know that that's an exact liability, so we could eliminate A as one of the potential answers, because A is $1,000 in accrued expenses. B is $1,000 in current assets, and because we're talking about current liabilities in this question and not current assets in this question, we could eliminate that as a possible correct answer as well. So let's move on to D. $1,000 in accounts receivable. Again, accounts receivable is just like A. It's a current asset. It's a specific type of current asset. So we know that we're talking about liabilities in this question, and we could eliminate that. We're left with C. Now let's analyze C as a potential correct answer. $1,000 in accounts payable. Have we incurred the services from the vendor? Yes, we have. Okay, let's look at the other half of it. Do we know what the exact liability is going to be for those services that the vendor rendered to us? Yes, we do, because we received a bill from Xerox, and we know that the exact liability is going to be $1,000. And because we both incurred the expense or the liability, and we know what the exact liability is going to be to the penny, those are the criteria for allowing us to post that $1,000 to the accounts payable account. So the answer to question 2 would be C, $1,000 in accounts payable. In the next video, lesson number 5, we will be covering the following topic: current liabilities on the balance sheet part 2, short-term debt and interest payable. Ladies and gentlemen, if you like my work, please hit the like button on this video. Please subscribe to this channel. Please share this video on all your social media, and please be sure to sign up as a Patreon member to enjoy exclusive benefits such as one-on-one tutoring, one-on-one consultation, and a more intricate accounting exam to optimize your learning experience. May God bless you, and see you in the next video.